Hey, it's Richard of Matthews Wealth Management. We're doing a market update, kind of a recap at the end of August, just to kind of show you what's been going on. If you're watching these market updates, you already know it's very numbers intensive, but we do this for a lot of clients that want to keep up with asset classes. So in this crazy year 2020 with COVID and so forth, we've been working on reallocations and we're looking for a point to reallocate back to where we were pre-March, more or less, with a few other changes. But we're starting to see some changes in these asset classes, so we'll just jump right in. If you're not big into numbers, go ahead and go to the next video. So first thing we've got in August, we're going to go through large cap value, core or blend, and growth, and then we'll jump to mid caps, small caps, etc. But we've got kind of the same trend. If you've seen the previous months or kept up at all this year, the gist of it is that growth is significantly outpacing value. So those would be like Amazon. Tesla is on an absolute tear, so is Apple. Pretty much anybody that mentions a stock split is going to go up in value for some reason. This is a strange world we live in, but we've got the same trend in large cap value for the month of August, where it went 3.5, 8, and 11. That's pretty substantial on the growth versus value side. Now, when we dive into mid caps, it's very different. We're starting to see, it's almost just like a wave of 4.5 or 3.5, 4, and then 3.5 again. So we're not seeing the big swings like we have been in previous months for mid caps or for small caps. Small caps is actually opposite. So we're starting to see that the values are going up greater than the growths. That's still atypical. That's still not a common situation there, but at least we're seeing some differences now as opposed to all growths go up. International is going faster than the emerging markets, which that might be a currency issue that we're looking at there. It actually on the 3-month flips a little bit, but bonds is where we're starting to see a lot of changes. And this is something in our third quarter meetings with clients, we talked a lot about bonds and what type of weightings we were interested in. Tips are up 1% on the month, short-term bonds flat. And then on intermediate and long terms, we're starting to see bond values drop. So when it comes to yield, everybody is diving, looking for yield, looking for some way to make interest. And actually the municipal bond world, it's completely dried up. When we're looking for anything, South Carolina, North Carolina, Georgia, Florida, etc., it's hard to find good municipal bonds anymore just because there's so much demand for it. But now we're starting to see things change a little bit. So the historical correlations between stocks and bonds is the seesaw, right? That when one goes up, the other goes down. And we haven't had that all year. It's just been everything goes up at the same time. And we're starting to see a little bit of discrepancy now in the bond values versus equities. So high yield bonds up another 1%. Real estate, it's treading water. It's where it is. Oil came up 5% on the month. Now we're seeing gold finally start to go downhill, and there's a lot of discussion as to what could be leading precious metals to be dropping. Right now, last month we saw silver absolutely take off on a tear, and I think maybe it's just kind of a tired market. We'll see how this swings as we get closer to the election this year, but gold turning down was a bit of a shock. That's kind of surprising, but again, there's some market dynamics involved there. Overall, the S&P 500 for the month is up 7.19%. So if we take the S&P at 7 and then we go back and look at growth at 11, we see a very high weighting on the growth side of things that's pulling the S&P up so high. Dow Jones moderate, that would be kind of a 50-50 stock portfolio that Dow Jones just throws out there as an index to track somebody that's half risk, so to speak. So they were up 2.73 on that index. So that's the month of August, starting to see some changes, which is good. But if we roll back now to look at June, July, and August, the last 3 months, we see a much more exaggerated picture of what I was referencing before, where we have very low returns on value, 4.5 and 22.5 on growth. And we see the trend continues through mid caps from 9 to 15, small from 9 to 14. So that's the trend that has been there, and we're starting to see things flatten a little bit there. So that's promising, saying that maybe the market is starting to look at what a company profits or what their revenue looks like, or their book values, and actual qualitative analysis there. So let's see, jumping into international, this is what I was referencing before. Emerging markets up 19, almost 20% in the last quarter, whereas international developed, which would be like Europe or Japan, they're up only 11%. Those are great, huge numbers. Not so much on the year to date, the world of COVID and so forth, but this is typical that you would expect emerging markets to go up quicker than international. Then we look at the overall bonds, and this makes a lot more sense. 4.5 on the quarter for tips. That's really high, but that's reasonable when we're looking at the big picture here. And then you have a normal spread there from 0.5 to 3 on the returns for bonds based on longevity of holding it. High yield bonds 6.7, real estate up 7.6, oil 18. Obviously we've been raising the price, watch the gas pumps there, but let's see, a little bit more demand, and they haven't really turned on the supply yet. Gold 11 on the quarter, and then the S&P 15, and you can see a much better relationship of the 50-50 portfolio under moderate versus the S&P, much more reasonable than what we saw in August. So that obviously comes from these guys. So year to date, this is where it's pretty much, let's look at what the value of these holdings actually is for this year, factoring in the dip that we experienced back in February, March. So large cap value is down 11% still, and that's including these returns, obviously. So we're still down 11% in large cap value, and we're up 33% in large cap growth. So that's the night and day problem, if you ask me. That's the bubble that we're seeing here. We know that the economy has taken a nosedive as we did a big shutdown, and all these businesses went out of business. They're still not at full capacity in restaurants. There's still supply chain issues, lumber going up for real estate costs and so forth. So we know that the productivity of the economy isn't there. So how in the world is something worth 33% more than it was in January? I don't know. There's no way to really explain that, except there's a lot of speculation out there. We see even more pronounced here in mid caps, from -18 to +24, -21 to 14. So if you ask me, that looks like a very obvious bubble. It seems like as the economy does get back in gear, this looks like a pretty good place to make 11%, 17%, and 21%, just getting back to where we were. Whereas I feel like that's probably out there. So I had a couple of calls today asking, should I be buying into Apple and Tesla and so forth? And I can't make a good case. If you can, write it in the comments. That'd be good to read and follow up on. But international still down 4, emerging markets flat. TIPS are up 9%. So TIPS stands for Treasury Inflation Protected Securities. So if we're looking to tread inflation and we see a 9.63 on a year to date, it's kind of a scary time for inflation, which backs down to commodities and so forth. But short-term bonds 3, 6, and then long-terms are up 14% on the year. So had you been in long-term treasury bonds and large cap growth, you've had a great year. The person who's just been, the normal large cap value, the blue chips, and then diversified bonds across the board, they're not doing as well. So it makes a big difference which of these classes you were in and which ones you avoided. High yield bonds actually pretty flat. So high yield has been a very interesting asset class this year with some Federal Reserve purchases, but that's a whole nother subject. Real estate, we're still down about 10% on real estate holdings. I've told clients I expect profitability on real estate to shrink. The values of housing and so forth will continue to go up for no other reason than inflation that's coming. But to make money in that world, the incomes, leasing and renting, will not necessarily keep up with that. Oil still down 64%. So again, if you want to find where's an opportunity as the economy gets back going, that looks like it's on sale for 64% off. Gold's up 26, almost 27%. Silver's in the same ballpark. Actually, it's north of 30 still, but it's been a good year for precious metals, and again, that's a currency hedge. S&P is up 9% on the year. A Dow Jones moderate portfolio would be up 2.77, which is not much, but that's what the diversified portfolio, when you throw these typical weightings in there for what a moderate risk would do, you would have a high percentage of stocks in the value side. of the chart if you go back and see how we do asset allocation here at Matthews Wealth Management. But along those lines, total practice year to date, our best short-term account, and just to review what that means, is a client that came on board or brought in cash back in February, March, and April. That's short-term investing where we were able to buy a lot of stuff super cheap out there on the market. So you can see it definitely has outpaced where we were on the longer-term investments for other clients, or other accounts. The best short-term account that I have is up 38%, and that would be kind of since March. The best long-term, which would account all the way from January 1, somebody that we've just constantly been managing, up 24.5. The worst one is down 5.5 still, and the average 3.48. So as you know, most of my clients are already retired or retiring. About 70 to 80% of clients fall in that world. The others are small business owners, young professionals, executives, and so forth. So we're kind of average, right around a moderate risk, which is why I like to use that benchmark there. So for comparison purposes, we're beating our benchmark. We're happy with that. But each client individually, we look at alpha as a statistic, and we're very happy. This has been a great year for alpha with the changes that we made back in March, what we're looking to change here in the next day or week. I'm not sure exactly, but we've got some reallocation opportunities coming up, and I start to see some inflection points. So again, stay tuned. We'll do a review in October, looking back at this month of September, and see exactly what's different then. So stay tuned, come back, and we'll see you next time.